In the late 1990s, one company on Wall Street seemed unstoppable. It was bold, innovative, and incredibly powerful. Analysts called it the future of American capitalism. Politicians praised its leadership. Investors rushed to buy its stock. That company was Enron. At its peak, Enron was valued at more than $70 billion, and its influence stretched far beyond the energy sector. It was supposed to be a revolutionary company that had transformed the way electricity, gas, and even internet bandwidth were traded. But behind the glamorous reputation and the soaring stock price was something very different, a financial illusion that would eventually become one of the largest corporate frauds in history. The story of Enron begins in 1985, when a businessman named Kenneth Lay merged two natural gas companies, Houston Natural Gas and InterNorth. Lay believed the future of energy was not just in producing gas or electricity, but in trading it like a financial asset. Instead of simply selling energy, Enron would become a marketplace where energy contracts could be bought and sold, just like stocks or bonds. The timing was perfect. During the late 1980s and early 1990s, the United States began deregulating its energy markets. This meant companies were suddenly free to compete and trade energy in ways that had never been allowed before. Enron moved quickly to take advantage of this new environment. The company began building a massive energy trading platform where businesses could buy and sell electricity, natural gas, and other commodities. Traders inside Enron's offices in Houston were encouraged to act like Wall Street investment bankers, making aggressive deals and taking enormous financial risks. By the mid-1990s, Enron was no longer just an energy company. It was becoming something else entirely, a financial trading powerhouse. The company's executives began promoting a bold vision. They claimed Enron was not simply selling energy anymore. Instead, it was creating entirely new markets where almost anything could be traded: electricity, natural gas, weather derivatives, even internet bandwidth. Investors loved the story. Wall Street analysts began praising Enron as one of the most innovative companies in America. Business magazines celebrated its leadership. In 2001, Fortune magazine named Enron America's most innovative company for the 6th consecutive year. But innovation was not the only thing happening inside Enron. During the late 1990s, a new executive rose to power within the company. His name was Jeffrey Skilling. Skilling had previously worked at the consulting firm McKinsey & Company, where he advised Enron on how to transform itself into a trading empire. When he joined the company, he brought with him an idea that would completely reshape Enron's financial strategy. It was called mark-to-market accounting. Under traditional accounting rules, companies record profits when they actually receive money from a project or transaction. Mark-to-market accounting works very differently. Instead of waiting for real profits, companies are allowed to estimate how much money they expect to make in the future and record those projected profits immediately. In theory, this method could provide a more accurate picture of long-term contracts. But in practice, it gave Enron something extremely powerful: the ability to record massive profits on deals that had not yet produced a single dollar in real cash. For example, if Enron signed a 20-year energy contract, the company could calculate the total expected profit over those 2 decades and report the entire amount as income right away. That meant a deal signed today could instantly create hundreds of millions of dollars in reported profits, even if the money might never actually arrive. At first, the strategy seemed brilliant. Enron's reported earnings began rising dramatically. The company appeared to be generating enormous growth year after year. Investors saw the numbers and believed the story. Enron's stock price began climbing rapidly throughout the late 1990s. Inside the company, executives became celebrities. Jeffrey Skilling was widely regarded as one of the most brilliant minds in corporate America. Kenneth Lay, the company's chairman, was deeply connected to powerful political figures and influential business leaders. But there was a problem: the profits. Enron was reporting were often based on extremely optimistic assumptions about the future, and when those projections failed to match reality, the company faced a dangerous question: where would the missing money come from? By the end of the 1990s, Enron had quietly begun accumulating enormous amounts of debt. Many of its ambitious projects were not generating the profits executives had promised. Some ventures were losing money entirely. Yet the company could not allow its financial statements to reveal these problems, because Enron's stock price had become the foundation of everything. Employees' retirement funds were heavily invested in company shares. Executives were being paid millions of dollars in stock options. Investors across the world believed Enron was one of the safest and most innovative companies in America. If the truth about its finances ever became public, the entire system could collapse. So Enron's leadership made a decision. Instead of admitting the losses, they would hide them. And the method they used to do it would become one of the most complex and controversial financial schemes in corporate history. Hidden network of partnerships and off-balance sheet entities designed for a single purpose, to keep billions of dollars in debt completely invisible. For a while, the strategy worked perfectly. Enron's stock continued to soar. Investors remained confident. Wall Street analysts kept recommending the company as a strong buy. By the year 2000, Enron's market value had reached nearly $70 billion, and its annual revenues exceeded $100 billion. From the outside, it looked like one of the most successful corporations in the world, but beneath the surface, the structure supporting Enron's empire had already begun to crack, and the system built to hide its losses was about to spiral out of control. Because once deception becomes the foundation of a company's success, there is only one direction the story can eventually go down. During the summer of 2001, Enron was still widely admired on Wall Street, but inside the company, some executives had started noticing disturbing patterns in its financial structure. One of those people was Sherron Watkins, a vice president at Enron. Watkins had worked within the company long enough to understand how some of its financial partnerships operated. As she examined the details of several transactions involving the SPEs, she became increasingly concerned about the risks they posed. The more she studied the arrangements, the more it appeared that Enron had created a system that could collapse if investors ever lost confidence in the company. In August 2001, Watkins made a decision that would later become one of the most important moments in the Enron scandal. She wrote a detailed memo to Enron's chairman, Kenneth Lay. In the memo, Watkins warned that the company's accounting practices could cause a massive corporate scandal if they were ever exposed. She specifically warned that the partnerships designed to hide Enron's debt could unravel and destroy the company's reputation. Kenneth Lay received the memo and began consulting lawyers and internal investigators. But instead of immediately revealing the risks to investors, Enron's leadership largely continued business as usual. At the same time, another major change was taking place. In February 2001, Jeffrey Skilling had been promoted to Chief Executive Officer. Skilling was widely seen as the architect of Enron's transformation into a trading empire. His leadership style emphasized rapid expansion, aggressive trading strategies, and constant innovation. However, by August 2001, Skilling suddenly resigned from the company. The official explanation cited personal reasons, but the unexpected departure raised serious questions inside the financial community. Enron's stock, which had once traded near $90 per share, began to decline as investors started to worry about the company's future. Behind the scenes, the partnerships used to hide Enron's debt were becoming increasingly unstable. As the share price fell, the financial guarantees supporting those partnerships began to weaken. A system that had been carefully constructed to conceal losses was now beginning to unravel. In October 2001, Enron announced a massive financial loss and revealed that it would reduce shareholder equity by more than $1 billion due to transactions involving its partnerships. The announcement shocked investors. For the first time, the complex financial structures surrounding Enron were beginning to attract serious scrutiny. The U.S. Securities and Exchange Commission, SEC, soon launched a formal investigation into the company's accounting practices. As investigators and journalists began examining Enron's finances, the scale of the problem became impossible to ignore. Billions of dollars in debt had been hidden through off-balance sheet partnerships. Many of the deals had been approved by executives who personally benefited from the transactions. Investor confidence collapsed almost overnight. Enron's stock price plunged rapidly. Employees watched as the retirement savings they had invested in company shares lost most of their value within weeks. By December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in United States history. More than 20,000 employees lost their jobs. Billions of dollars in retirement savings were wiped out. Investors across the world were left stunned that a company once celebrated as one of America's most innovative businesses had collapsed so suddenly. In the years that followed, several top executives faced criminal investigations. Andrew Fastow eventually pleaded guilty to multiple charges related to fraud and conspiracy and served time in federal prison. But even years later, the collapse of Enron remains one of the most powerful warnings in the history of modern finance. It revealed how quickly a company built on reputation and investor confidence can collapse when transparency disappears. It also showed how complex financial systems can hide enormous risks until it is too late for investors to react. For a brief moment in the late 1990s, Enron had convinced the world that it represented the future of corporate innovation. In reality, it had become a symbol of something very different, a reminder that in financial markets, growth built on deception rarely survives the moment when the truth finally comes to light.